Found an article in Business Insider. Mortgages and credit cards are about to get even more expensive. Since the beginning of 2022, it's gotten way more expensive to take out a mortgage, hold credit card debt, or get a loan of any kind. I was actually amazed. My third daughter, I have four. Those of you who listen regularly know that, but I have four daughters. My third daughter just became a nurse at Emory University Hospital, and so she's making her own money, and she decided she wanted to buy a car, and the interest rate on her car loan was 10.74%. Now, she doesn't have a lot of established credit, but she's got a good job. She's got proof of income, and it just costs that. Now, I'm not saying she couldn't do better than that, but that's a lot when you think about it. Experts say the surge has only just started. The Federal Reserve's inflation fight hit a fork in the road on Tuesday, September the 13th, when the Consumer Price Index was updated. Had inflation cooled more than expected in August, the central bank might have eased up on its interest rate increases, and the economy just might have avoided a growth recession. I don't even know what that means. That's what it's being called. Inflation slowed, but only barely. It went from 8.5% to 8.3%. I don't know if you are anything like me. When I go to the grocery store now, every time I look at the total, I think, dang, that's a lot. Like things that seem like they used to cost $80, now I'm spending $120 or some crazy number on it. So inflation is definitely there. Fed officials have been clear they'll only pull back their rate hikes once they see compelling evidence that inflation is slowing down. There's no chance now of the Fed slowing its roll and raising interest rates by only half a point. Markets, economists, and analysts see another 0.75%, 0.75% hike. The third in a row is all but certain. It's expected on September the 21st. Interest rates serve as the Fed's best tool for slowing rate of price growth. Higher borrowing costs tend to slow economic growth as Americans rein in their spending and businesses slow their plans for expansion. Demand drops, supply catches up, and the pressures driving prices higher ease. If you're looking to buy a home, there's probably a good chance that there's still upward pressure. The Federal Reserve does not actually set the interest rates for home mortgage loans. That is more so set by the yield on the 10-year Treasury bond. So it's more influenced by the market and the appetite from investors all over the world. So it is possible that the Federal Reserve can raise interest rates without mortgage rates going up, but I would say it is not probable. Economists are now bracing for a much more aggressive hiking cycle through the rest of the year, complete with more jumbo-size hikes and little signs of slowing down for the average American. That's going to mean expensive loans, smaller raises, and the heightened risk of job loss. Man, when I think about that, man, it just makes my heart hurt. Traders now expect a considerably more aggressive hiking cycle through the end of 2022. A slim majority now sees officials raising rates by another 0.75 points in November to a range of 3.75 to 4.0. I've got a home equity line of credit on my home, and that interest rate continues to go up. My payment has gone from $700 a month to $1,100 or $1,200 a month. It's a lot. So interest rate hikes, they're good, by the way, for retirees, people who have fixed income assets, because you can typically get more interest, and that's good. So I've got a CD where I'm making some more money, but I'm certainly spending more money as well.